Well, 2025 was a year to remember, but also a year to forget. During the first quarter, global investors were very anxious with the talk of new U.S. tariffs globally. This accumulated with the market sell-off in April with the announcement of new U.S. tariffs on over 180 countries. As investors were panic selling, we were buying high-quality growth companies on fire sale prices for both the Macro Canadian Equity Fund and the Macro Opportunities Fund. We stuck to our motto that every crisis is a buying opportunity and bought new and added to existing positions to take advantage of the market swoon. Our belief at the time was that new tariff rates were ridiculous and the U.S. was using this as a negotiation and punishment tactic on its trading partners. As investors came to see that this was the case, markets started recovering as tariffs were either delayed or new trade deals with lower tariffs were announced. In addition, the combination of better-than-expected earnings for companies, tame inflation, and expectations of lower interest rates drove markets to all-time highs. In addition, gold and silver prices rallied strongly as a hedge due to geopolitical uncertainties. Both funds participated in this rally. First, as many of our companies beat expectations. Second, both funds had exposure to gold and silver companies which benefited from the commodity rally. Now let's turn to the Macro Canadian Equity Income Fund. For the year, the fund was up 27.8%. The fund's dividend yield at year-end was 2.5%. During the year, we bought 19 new positions and sold 16 existing holdings. Through it all, we stayed true to our approach. Invest in stable, fairly priced companies that reward shareholders. Top sector weights at year-end were financials at 33%, industrials at 19%, and energy at 17%. Our total gold and silver sector exposure was 9%. Now, let's turn to the Macro Opportunities Fund. Small and mid-cap companies performed very well during the year as earnings also beat expectations, and the Bank of Canada cut interest rates again. Small-cap stocks usually do well when central banks are cutting interest rates. The fund year-to-date performance was 43.9%. We continue to search for underfollowed or out-of-favor companies that have revenue or earnings inflection points over the next 12 months. Over the year, we met with over 90 potential portfolio companies. As a result of these meetings and our further due diligence, we add 26 new companies to the portfolio and sold 16 existing holdings in the fund. During the fourth quarter, we had 4 of our portfolio holdings receive takeover offers. These holdings were sold typically within 48 hours of the takeover offer, since we do not want to take any deal risk for the fund. The fund is strategic positioned across these key sectors: technology at 28%, materials at 27%, industrials at 15%. Gold and silver sector exposure was 16%. Both funds have exposure to our secular themes of geopolitical risk, increased power consumption, and infrastructure renewal. Now, as we start 2026, we remain positive on the stock market based on the following factors. First, central banks continue to cut interest rates. Second, federal spending will start ramping up to offset the negative impact of U.S. tariffs in Canada. And third, Canadian stocks relative to other adult markets remain inexpensive. That said, given the strong stock market in 2025, we remain aware that higher volatility this year and a market pullback is possible based on headline risk due to rising geopolitical tensions in the upcoming U.S. midterm elections later this year. In fact, if a pullback occurs, we would see this as another buying opportunity for long-term investors.